Okay, let's jump right in. We are looking today at a convergence, a really high-stakes convergence of market indicators. And according to veteran analyst Andy Schectman, they point to a definitive financial turning point.
Yeah, it's not just a typical market volatility. This analysis suggests the system itself is showing real signs of structural failure. We're seeing it across, well, three critical areas.
Exactly. The source material we're examining suggests the financial rulebook, the one we've all been using for decades. It's being torn up and rewritten right now, in real time.
And maybe the most dramatic fact to start with, the largest silver refinery in India.
India, one of the world's biggest physical buyers.
Right. That refinery is completely out of stock, bone dry. First time in history this has happened.
Wow. Okay, so that's not just a small issue, that's a global alarm bell for physical supply.
Absolutely. A physical supply shock.
And while the actual metal is vanishing, the paper market, well, Schectman says it has explosion written all over it.
That's the disconnect, isn't it? You've got managed money funds, like hedge funds, over $1 billion short on silver,
Betting against it.
betting hard against it. But then the commercial banks, the big players, the ones who supposedly know what's really happening.
The market makers?
Exactly. The smart money, they're taking the long side. They're betting on silver.
That kind of massive opposition,
Yeah.
that sounds unstable.
It often precedes a sharp move upwards. The dumb money, as Schectman might put it, gets caught on the wrong side.
Okay, so silver shock, paper market explosion. What's the third alarm bell?
This one isn't precious metals, it's the banks themselves. There's this kind of silent distress building up underneath the surface.
How do we know?
Because banks are apparently so desperate for quick cash, for liquidity, they're resorting to pawning off risky mortgage-backed securities.
Instead of...
Instead of the usual safe, reliable U.S. treasuries to get overnight loans from the Fed.
Whoa, okay, that sounds bad, like really bad.
It's the financial equivalent of, pawning your wedding ring because you've sold everything else of value. It signals serious strain.
And the Fed's response concerns it?
It seems so. The Fed quietly opened up this massive emergency lending window. We're talking over $490 billion. Almost $500 billion.
$500 billion? Quietly?
Quietly. Injecting that kind of money unannounced, it suggests they see something serious beginning to fracture.
Okay, so our mission here is clear. We need to unpack this analysis quickly, this thesis that these points, the physical supply collapse, the institutional flight to safety, this hidden banking distress, prove the system isn't just struggling, it's actively breaking.
And before we really dig into those details, it's probably a good moment to talk about trust. If you rely on this kind of focused analysis,
This high-level stuff.
you absolutely need to trust your sources. The analysis we're looking at highlights a connection going back decades, like when Credential Beige nominated Miles Franklin as an authorized reseller. That's a serious institutional nod.
Right, a mark of real credibility.
In a world just full of noise and, frankly, bad information, you've got to find and subscribe to sources built on that kind of foundation, that vetted trust.
Absolutely. Okay, let's dive back into the silver supply, the vanishing physical metal, that India refinery running dry. It's unprecedented.
Totally unprecedented. And the ripple effects are already hitting the market, especially in London, the LBMA.
The London Bullion Market Association. What are we seeing there?
Well, for one thing, it's been in backwardation for 18 straight days.
Yeah.
Now, that might sound like technical jargon.
Yeah, slow down. Explain backwardation. What does 18 days of that actually mean?
It means the price for getting physical silver delivered right now, the spot price, is significantly higher than the price in a futures contract for delivery later.
So people are paying extra just to get it immediately.
Yes. Schectman noted spot was trading, I think, $1.24 higher than futures at the time. It's a panic premium. You're paying extra because you want the real metal in your hand now, not just a paper promise for later. It shows this deep distrust in future delivery.
Okay, that makes sense. Panic for the real thing. And what about the cost to borrow paper silver for the short sellers?
Oh, it's insane. Absolutely insane. If you want to borrow shares of SLV, the big silver ETF, to short it, you're paying a 19% annualized lease rate. 19%.
Just to bet against it.
Just to borrow the paper to bet against it, but it gets worse. On the LBMA itself, where the big institutions play, the lease rate hit a staggering 39%.
39%. That's not a functioning market rate.
No, that's a crisis rate. It screams panic from institutions who shorted metal they now can't find to deliver. They're desperately paying huge amounts just to maintain a short position they can't physically cover.
So they're trapped.
It signals they might be. It points towards a potential failure to deliver, which is a massive crisis of confidence in the paper market itself.
Okay, so this panic in silver, it's like the canary in the coal mine for a much deeper crisis of confidence.
I think that's a fair way to put it. And that crisis is forcing major financial players to basically tear up their old playbooks.
Which brings us to the next point. Institutions abandoning the old rules, the sacred 60-40 portfolio.
Yeah, 60% stocks, 40% bonds, the bedrock of conservative investing for decades.
It's dead.
According to some major institutions advising their big clients, yeah, pretty much ditch it.
And we're not talking about some fringe bloggers here. Who's saying this?
Morgan Stanley's chief investment officer recommending sophisticated institutional traders move away from 60-40, their new model. 60% stocks, 20% bonds, and 20% gold.
Wait, 20% gold from Morgan Stanley. That's huge. That's almost unheard of from a mainstream giant like that.
It is a monumental shift. And they're not alone. Michael Hartnett over at Bank of America, he pushed it even further.
Further than 20% gold.
Yep. He suggested 25% stocks, 25% bonds, 25% short-term treasuries, and a full 25%, a quarter of the portfolio in gold.
A quarter in gold. What about the bond king, Gundlach? He loves bonds.
Jeffrey Gundlach, yeah, made his fortune selling bonds. He apparently stated that even a 25% portfolio allocation to gold is not overweight.
Wow. Okay, so the guys who sell bonds are saying load up on gold. That tells you something. What's driving this? Why the sudden rush to gold?
The underlying logic seems to be a deep fear of systemic risk, maybe currency devaluation, a loss of faith in the fiat system. They're preparing for something major.
And the price targets reflect that fear.
Absolutely. Bank of America didn't just recommend holding gold. They raised their silver forecast to $65 an ounce next year. Their gold outlook, $5,000.
$5,000 for gold, $65 for silver.
And some top distributors, formerly Jeff Beige, are apparently targeting $6,600 gold as their next stop. These aren't small adjustments.
This kind of insight into institutional thinking, it's critical. It really separates reacting to headlines from understanding the deeper shifts.
Exactly.
And if this level of analysis, hearing what the big players are actually doing, is valuable to you, if it's opening your eyes, well, you need this information flow consistently. Hit that subscribe button right now. Keep this pipeline of critical analysis coming. Don't miss these shifts.
And we're seeing this shift happen in real time, not just in recommendations. Look at gold's price action. Last Friday, it got hammered, right? Down over $100.
Yeah, big sell-off.
But then it bounced back $108 almost immediately. Schectman points out that every single dip, every price drop, is being instantly bought up.
By physical demand.
By real physical demand. It's not just paper trading. The institutions are acting on these recommendations. They're buying the metal.
Okay, let's connect this back to the banks. What's the root cause of the distress that's making Morgan Stanley recommend 20% gold and banks pawn off risky assets?
Well, the analysis from Schectman is pretty blunt. The banking crisis isn't over. The core problem is bad loans.
Across the board.
Across commercial real estate, residential real estate, auto loans. They're going bad. Delinquencies, defaults, they're piling up.
The commercial real estate part seems particularly bad. I mean, you see those empty downtown office towers everywhere.
Exactly. The example cited was an attorney's office in Minneapolis, huge space, locked into an expensive long-term lease, but empty. That scenario is playing out everywhere.
And that destroys the value of the loans the banks hold.
Precisely. It wipes out the equity underpinning the debt, especially for regional banks who hold a lot of this stuff. So when these loans sour, the banks suddenly face a liquidity crunch. They need cash fast.
Which forces them into the repo market.
Right, the repurchase market. It's where they go for quick overnight loans from the Fed to manage their daily cash flow. Normally, it's smooth sailing. They use safe U.S. Treasuries as collateral.
But now, they're using the mortgage-backed securities instead. That's the crisis signal you mentioned earlier. Why is that specific shift so alarming?
Because treasuries are like cash. They're safe, liquid, top-tier collateral. Mortgage-backed securities, they're much riskier, less liquid, tied to the shaky housing and commercial property markets.
So using them instead means...
It means they've likely run through their best, safest assets. They're scraping the bottom of the barrel using volatile, risky debt to get essential overnight funding. It screams severe stress. Desperation, really.
And that stress prompted the Fed's huge quiet intervention. The $9 billion injection and that $490+ billion emergency facility.
Seems Directly related. You don't roll out nearly $500 billion in emergency lending capacity and keep it quiet unless you're seriously worried about something breaking.
What's the ultimate fear? Contagion.
Systemic contagion, that's the big one. If a major bank fails because of these bad CRE loans, or think about this, if a major bullion bank fails to deliver physical silver.
Right, because these aren't just niche banks.
No, they're universal banks. They have connections everywhere, lending, derivatives, investments. If one big one goes down, the shockwaves could ripple through the entire financial system. The Fed is trying to put up fire breaks without yelling, fire.
Okay, let's bring it all together. What's Andy Schectman's core warning in all this?
He argues, and it's quite compelling, that the powers that be, the Western elite, they've been masters of illusion, keeping the financial ball in the air with, policy tricks, accounting gimmicks.
But the illusion is fading.
It's collapsing.
Huh.
His point is simple but powerful. You can fudge inflation numbers, you can spin jobs reports, but you can't lie to mathematics.
Math always wins.
Math always wins. The basic laws of economics, supply, demand, the crushing weight of debt, they always assert themselves eventually. And seeing this physical metal shortage, this institutional panic into gold, and this $500 billion quiet bailout all at the same time, that suggests the math is asserting itself right now.
So this isn't just about markets anymore. It's about a fundamental loss of trust.
Trust in the currency, trust in the banks, trust in those paper promises, it's eroding rapidly.
Which leads to the final provocative thought.
Yeah. Considering these crises, the metal disappearing, the institutions running for cover, the banks needing secret bailouts, you really have to ask yourself, when this system finally resets, what assets actually hold their value? What will you be holding?
That's the critical question. Yeah, and if this analysis resonated, if you see the seriousness of this shift, you need reliable information.
Not just noise.
Not just entertainment.
Yeah.
The people providing the real data, the unvarnished truth, like the credible firms, the ones with history, maybe like the one nominated years ago by Credential Beige, they often get drowned out.
You need to actively seek them out.
Take control of your information flow. Subscribe right now. Stay informed on this accelerating financial transformation. Don't get caught unaware.